I can go out and buy the greatest looking deal in the market. And if I don't have the right people on site, I can screw that deal up pretty quickly.
Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we bring you interesting guests, all revolving around real estate, investing in real estate, making cash flow from real estate, building a retirement income from real estate. And so today we have a really special repeat guest, actually. It's Ivan Barratt. Welcome to the show.
Axel, it's good to be here, man. Thank you for having me. It's good to see you.
Yeah, and Ivan is the founder of BAM, and we have done this before a long time, and now he is real estate famous. So now I'm much more grateful even that he is willing to come on the show again. And before we get into any of the specific topics, Ivan, tell us, for those people who don't know you yet, how did you end up being and getting to where you are today?
Well, thank you. I'd always wanted to be in real estate. My uncle had a couple of apartment projects. My dad had rental properties. So at a very young age, I desired to own it and always wanted to have a big company and do it big. But started very small. So after working for a real estate developer for several years, and having a front row seat to the great financial crisis, the GFC, I decided to get into property management. I figured if I could grow a service-based company first, serving others and managing their properties, that I could one day get to do my own big deal. So in 2010, BAM was started. I was the only employee managing lots of single-family homes and duplexes and condos. Met a lot of investors from around the country, a lot in California, who were hiring me locally. They were doing turnkey investments at the time, buying single-family homes and townhomes, and I was the on-the-ground property manager. I used that to build infrastructure. I started hiring people, growing a management team. It was very difficult to do, but early on, we decided, what if we had a management team where people actually liked their jobs and focused a lot on growing culture and taking care of employees, taking care of our maintenance folks in the field, the ones responsible for keeping the assets up and keeping the residents happy. And I used that company to start doing my own syndications. Many of those turnkey investors of single-family homes and small deals became some of my earliest investors. And a lot of friends and family around Indianapolis, real estate contacts I had, anybody I could get in front of that I thought might be successful and wealthy. And from there, we started doing our own syndications. Several deals, several exits later, we started our first fund. Today, we're finishing out Fund 4 and moving on to Fund 5. We've done about $1.7 billion in total transaction volume, currently managing a portfolio of about $1.1 billion. So we've sold quite a few. And it's been fun. So far, we've done 9,000 units, mostly acquisitions, but also about 1,000 units of development in joint ventures with partners who are great at developing. We bring capital and balance sheet and management expertise to the table. And again, it all started very small. Today, we've got a bigger company. I was just telling you before the recording, right? A little over 200 employees in the family. Most of those folks are on site at an apartment community somewhere across the 7 states we're currently in. And, you know, life's a roller coaster, trying to be a good husband and a good father and grow a great business all at the same time. It's never a dull moment, Axel.
I can totally imagine. I know there's from our business as well. There's always interesting stuff and little turns and twists that you don't anticipate. Now, you mentioned it already, and that was actually my next question I wanted to ask you. I know that you started in Indianapolis. Do you feel that that was just an extremely fertile ground to start from? And can you describe a little bit that evolution? You mentioned 7 states, so that the audience has a little bit of an idea where your properties are nowadays and where you came from.
Yeah, I'm pretty lucky to be born in the Midwest and saw very early that many of these markets here in the Midwest We're successfully decoupling from that Rust Belt moniker, that flyover state um, um, classification that they get from lots of coastal folks and investors, and working in development and studying what it takes to put a development together from feasibility standpoints helped me realize that there was these world-class suburbs in places like Indianapolis, some places in Ohio, now Pennsylvania, Kansas, Arkansas, Illinois, and so on, that had these great world class suburbs. We never really bought into the urban idea that everybody was going to move downtown. We called BS on that, and that paid off really well for us. So we stuck to suburban garden apartments, great school districts, diverse employment picture, safe, where people are moving for jobs, people are moving for the schools. And in the Midwest, as we like to say, she doesn't boom, Axel, but she doesn't bust either. She is the tortoise
Right.
versus the hare.
Yeah.
Sure, lots of people go to the Southeast and the Sun Belt, and that all looks, really sexy. But when everybody's going there in search of deals, it tends to cram down returns. So we were able to find value for our investors here in the heartland.
Yeah, absolutely. And I mean, I have a few comments on that. One of which, and this is kind of where we have similarity, even though we have different places in the market and you have different scale by now. I think we all, and also for the benefit of the audience, even though I've been saying it so many times, and I'm sure you have too, is there's just something where I always encourage everybody who wants to work with us or with your organization to find your own answer on what does it mean to invest in real estate, right?
Mm-hmm.
And when you do that, I mean, for me, I would say if you don't have at least a 10-year time horizon, then probably not really call or shouldn't call yourself an investor in real estate. Now, that might sound very long if you're typically investing in stocks or stuff like that. But for real estate, I think that's about the time frame. That doesn't mean that the exit of a syndication has to be longer than 10 years or something like that. But what do I really expect? And especially with your point about the Midwest, I've always said, okay, you if you can have 3, 4, 5% um, appreciation, and you start looking at all the other things that determine how much cash flow, how much tax write-offs, how much other things you have, and it is possible to basically put them all together, and you're ending up somewhere in the 15 to 20%. I know that you also know Keith Weinhold, who we both know, and he's always doing the 5 income streams for real estate, right? And if you look at it that way, then there is, I think, a huge benefit in the assurance. I can pretty much depend on that. I don't have to wait that like the next Amazon warehouse is bought next door or somebody declares a certain location to be the sexy, like you said, thing that everybody needs to have a dependable return. Now, with that in mind, I have the impression, and I have been waiting for the opportunity to ask you this. When I look at what you call a fund or one of your signature properties, I always wonder if they fundamentally already exist like this, or if you take like a whole kind of, I don't know, neighborhood almost and make it into to look like what your ultimate end product that you then put out in your commercials and stuff. Is that the development side, the construction side that brings it to that standard?
Well, I think you're asking me, do the properties in the pictures really look like they look in the pictures?
No, no, I'm
Or
saying they look like that, and I'm sure they are like that. But when I look at the sheer size, I sometimes wonder, do you buy like kind of like a street block and then start working it out so that you have a coherent kind of concise thing, or is it from the get-go already pretty close to what the end product is going to be?
yeah, it's typically what the end product is going to be. So maybe some of our development joint ventures, the developer has assembled land or bought several parcels and combined them together to develop something from scratch. But typically here in the Midwest and really in the United States for the most part, what we're buying are garden apartments that were purpose built as apartment communities with a clubhouse, a number of buildings that have been approved by the local municipality, resort style pool, all the amenity sets that we look for in that asset. And I would just add, there's a lot of truth to what you said, Axel, about how to look at real estate. It's a long-term play a lot of the time, and I would want to be able to hold something for 10 plus years if needed, if the market is not there to sell.
Right.
I would just add on to that real estate is a business, and especially when you start getting lots of units. Now we're managing over 6,000. Most deals are over 200 units in a specific location, sometimes much more. It truly is an operating business. It's a very intense management asset class, and the key to making that a dependable investment is the people that are in charge of managing and maintaining that asset. And I can go out and buy the greatest looking deal in the market, and if I don't have the right people on site, I can screw that deal up pretty quickly.
Yeah, absolutely. So can we talk a little bit for a moment about how much is kind of new construction or close to new construction versus renovation?
Yeah, out of 9,000 units, we've acquired a little over 8,000, and we are in development on just shy of 1,000 units with our joint venture partners. So vast majority of what we do is we look to buy a business, fix that business or optimize that business, and then eventually sell that business to provide the return target that we have targeted with our investors.
Okay, yeah, very
It
good.
just so happens, Axel, that business is an apartment community.
Yeah, yeah, no, I totally get it, and I'm a big advocate. I think you may remember that I said over and over in podcast episodes and under other opportunities, even if you are an employee, like when people ask me who you're looking for, I always say I'm looking for Henrys. You high earning, not rich yet,
Huh?
so and but the point
That's a
about
new
it
one for
is,
me. Henry, got it. High earning, not
yeah,
rich
you
yet.
can steal that or use it. Hey, let's take a quick break for a message from our sponsors. If you're serious about growing your wealth, you know the best opportunities aren't always the most obvious. That's why we've partnered with Bob Bernodas of Franchise with Bob. He specializes in helping investors like you leverage franchising in an overlooked but highly profitable way to create semi-passive income. And for a limited time, Bob is giving our listeners access to his course on franchise investing for free. Inside, you'll learn how to evaluate franchises, minimize risk, and maximize your returns. This course is normally sold for $499, so don't miss out and claim your free course now at edu.franchisewithbob.com/ideal. But the point is, so let's say you are in a relatively high-priced area, you live there, you have a good job, you are a Henry, and you're looking to invest. The aspect for this investment, whether they do it on your scale in a syndication with BAM or for like pure ownership of a single unit or duplex, triplex kind of property, is to learn. And I phrase it this way: you have to learn, and I, as the mentor, help people to learn to be the person in charge. You're
Mm,
hiring property management, you're hiring a lender, you're hiring an inspector, you're hiring an insurance agent. Yes, they're not really employed in the traditional sense, but from your role and your understanding and your mindset of the role, you
sure.
are in charge and you're running a business. The BAM LLC or the Axel LLC or whatever you call it, or like um, what did one of our clients call us, swamp wobbler? So but the point is, while you can be a Henry going to work or work for somebody else, when it comes to your investment, you are basically the business owner, right? And that mindset and adjusting your mindset into that role is what a lot of people struggle with.
Well, I think
getting
that's
it.
why we've done so well as a company and in the industry and in syndication and fund management, asset management, is that we partner with individuals, um, lots of Henrys, but also lots of people who are quite wealthy already in their given profession or their business, and they've got hobbies, they've got kids, they've got a marriage,
Oh,
they've got travel, they've got sports, whatever it is. They want a partner who can take a lot of that off their plate and deal with the day to day and the overall execution of the business plan so that they don't have to. And that's why our industry has become so strong, is because there's a lot of individuals out there like that. But I would also say that they should listen to what you're saying as well, in that it still takes a lot of education. You still have to sort of steer your own ship, and learn how to be a great investor, learn how to identify and evaluate management teams more than individual assets. It's mostly about the sponsor and the management team executing the deal. As I said, lots of people can put a deal together and go sit at a closing table and get it done. It's what happens when the rubber meets the road and it's time to execute the business plan and manage an operating company.
yeah, exactly. And I mean, we touched a little bit before we hit record on you building this family or family,
Yeah,
as you call it. And I'm sure in that sense, you and your team, your management team or the executive team are looking at each and every one of them and are they meeting the criteria? And on a smaller scale, that's what I'm getting at. If you have a property manager for your turnkey property and it's just not doing the job properly the way you expect it, well, then you have to find a new one, right? And what
absolutely.
I'm yeah what I would like to ask you a little bit, if we can touch on what would be kind of like the criteria, the level of investment. If somebody says, okay, I understand if I work with Axel on a single family duplex thing, it is still passive, but I'm more involved. I have kind of to run my business a little bit more hands on, even if I get help.
Yeah.
When if I go to Ivan, it's basically all done for me. Can you give a little bit of an example for one of your current funds on how that would look like for anybody in the audience to say, this really almost totally hands-off passive. What does it cost? What are the criteria? How do I can participate?
Well, the criteria is we can only partner with accredited investors who have a net worth of 1 million or more, or make 200,000 a year for at least the last couple of years. Our biggest, excuse me, our smallest check is $100,000, and our biggest check is well north of 10 million. And we have 1,400 investors and growing. I think we grew that by almost 350 investors this year alone. And so everything in between that 100,000 and I think the biggest check's like 13 million and change. What we
Okay.
seek to deliver for our investors is an annualized return somewhere north of 15%, although we've been doing far better than that. We like to underpromise and hopefully overproduce.
Right.
So for the people out there that like IRR, we like to be north of a 15, although the last several years we've been north of 30% annualized returns or compounded returns. My worst deal yet just sold yesterday. It'll do a 17 and a half IRR on 7 years. And if you like multiples, that's 2.6 times your capital. So for that investor that put in $1 million, they got $2.6 million over that 7 years in returns. And yeah, the investor gets great reporting. They get my team on the phone anytime they want. If they write a big enough check, they talk to me a couple times a year.
Okay.
Yeah.
Yeah.
I can't talk to everybody like I used to, which is why video is so great. And we're
Yeah,
the ones
absolutely.
out there kissing toads, looking for the best deals possible. It is really freaking hard to make money at this. It is incredibly difficult to execute, but we've been at it for a while. One thing I would stress to anybody about buying real estate is the one thing you can't change is what you paid for the asset. So I have to be very disciplined on what I pay for a given asset. And, we are forced appreciation type guys.
Yeah.
So we look to create value in the property. based on the amount of net operating income it's generating. And I look for ways to add a dollar to the bottom line, which makes it worth $20 more when I sell it, roughly $18 to $20. And we typically now are doing 60 to $80 million deals. But really, Axel, at the end of the day, just to distill this all down, forget all the big numbers for a second. It's just you and me going out and buying a property together. And you bring most of the capital, I bring some. Uh, you say, Ivan, you do the management, the hiring, the firing, the maintenance, all the work, right? And then you, as the investor, get a preferred return and a percentage split of the profits. So you get the lion's share of the returns, but I make the decisions, I run the day to day. And what it is now, it's still just a partnership at its core. But what we've done now is because economies of scale and bigger is better in this business, we take lots of investors together into that partnership. And instead of going out and buying one apartment community of 300 units, in Fund 4, for example, we bought 1,626 apartments across 4 different cities here in the Midwest. 6 communities, all very well built, relatively new assets built in 2015 or newer. And so whether that investor is putting in that $100,000 check or that $1 million check or more, their capital is being spread across 1,626 units, which are, last check, I think approaching 94% occupied.
Yeah, that's very cool. And I mean, one thing that I was wanted to touch on in that context is you mentioned scale. So what we have seen, obviously, and this is commercial real estate at that scale, obviously, is the cost of money is obviously way different than it was 3 years ago,
Mm-hmm.
or 4 years ago. For the audience, when you're listening to this, we are in 2025, and
It
so
is the best time to buy real estate since 2010,
right. I always say that too, but we cannot deny that money is more expensive than it used to be.
as it was in
Uh,
2010.
Yeah, exactly. The other thing is it's not just the expense of money, meaning interest, but it's also the cost of, the materials and stuff for renovation, some of the labor costs. You said before we started, it is freaking hard to do. That doesn't mean it can't be done. You are the living example, not you only personally, but the family and BAM as an organization is the living example. But can you tell a little bit what the differentiator is, especially at the scale that you do it, that allow you to get to those numbers?
Yeah, well, first, I want to say like what you said earlier, money is more expensive, debt is more expensive. But I would tell anyone out there that if debt is driving whether you do a deal or not, you're not looking at the right things on the deal. Debt, debt is important tool, but if your cost of capital is driving the ship, then you might not be underwriting the deals correctly, right? And we could spend a whole period or a whole podcast on that. So I don't want to go down that rabbit hole too much, but there's a lot more important things that go into buying assets and making sure you're buying them for the right price. Um, our differentiator is back to what I said in the beginning. It's what if we had a management company where people like their jobs? We've
Yeah.
got one of the lowest turnover rates of employees in the industry. We treat our maintenance folks like gold. We really take care of them, and we have in-house training, which I couldn't do if I only had a few units or if even a few hundred units. But on a full-time salary to be in-house training so that my maintenance team is certified in HVAC, light electrical, light plumbing. So one way we save a lot of money and why we love buying deals from folks that are using third-party managers is we know
Okay,
how to run
totally.
these things more efficiently. And when we target certain third-party managers that always call a contractor to fix the HVAC, we can save sometimes 60, 70% in costs just by repairing HVAC in-house. And then there's 100 ways to save a penny here, a nickel there, a dime here. And all those dollars add up. And remember, every dollar equals $20 of value when I go to sell, because these are valued on their income, not the comparison approach like single family. Um, and so that's some of the ways that the economies really benefit our model.
Yeah, absolutely. And I appreciate that you mentioned this. And you kind of almost in passing, I think you deserve a lot of credit for that, mentioned the 94%. I would say if somebody were to ask me, what do I see when I look at BAM? Then I would say the things that you just mentioned about the people that you have and how you treat them, and include the tenants. Because I believe you can only have high 90% occupancy rates when it's not just a good product managed by good people, but also the tenants being happy and have no reason to leave. Right. And so if you take all those things together, and there are some similarities in
Well,
the smaller scale, you know.
I think that's probably more true for single family and 1 to 4 family homes. And we call them residents now, our communities. But
Okay.
our residents, even if we're doing a great job, 40% of them turn over a year.
Really? Wow.
Even
Okay.
if we're doing a great job, 40% are going to move out and move on. And so, yes, we want to have a great resident experience. We send move-in surveys. Somebody comes out to perform a work order. We send a survey. How do we do on that? We want them to really have a great experience. But the employee managing that property is going to be around much longer than that resident. And so at BAM, we are by far an employee first company. And
Okay.
the resident is a distant second, Axel.
Yeah, I didn't know that. I mean, just for my curiosity, any reason why they have such a short residence, so to speak?
Well, in general, apartments are a very transient asset class. You get people moving in and out, right? Student housing, which I would never do. People make a lot of money at it. It's great if you're good at it, but it's not my core competency. You're moving out everybody every year. And
Yeah.
typically in multifamily, you're seeing about a 40% turnover of your residents, and that's an industry benchmark. Build to rent, much more expensive to run and operate, but you're seeing far less turnover because somebody is settled into a single family home type of environment.
Yeah, exactly. I mean, this is, on our end, and I mean, there are obviously, and I don't mind this. I actually appreciate that when we have a guest like you and we have our kind of part of the pie, we are striving to have them. I have actually the longest tenants, I think, are now approaching 6 years,
Yeah,
and
yeah. You don't really you see that a little bit in apartments, but remember we've got currently over 6,000 residents across the portfolio. A certain percentage of them every year they're going to move out. We're seeing far fewer move out to buy a home. But people are a lot more mobile these days. They're moving from town to town for job opportunities, various reasons. Yeah,
yeah, absolutely. So before we come to a close, I would like to ask you, since you have so much experience, not just for your scale and for your type of industry, but residential real estate, if you're willing to go a little broader, where do you see us
let's do
go?
it.
Like go to like end of 25, maybe end of 26 at those two milestones. Where do you think it's going?
Well, so as I said earlier, this is like the third correction of my career. 2008 being the first one. We had a very quick one for 2 quarters in 2020 at the beginning of COVID when everybody thought it was 2008 2.0 again.
Yeah,
And
right.
there was a very short window there where we were able to buy some really choice assets. And then really for 2023 and 24, we've been in another buyer's market. There is more deals than there is equity to buy those deals. A lot of equity's dried up. So there's a lot more opportunity, similar to like it was in 9 and 10. So for those of us that can put equity together, it's been a great time to buy assets. Um, I think that could continue through 2025. The Fed is going to reduce rates. The short end of the curve should get down to maybe 3, according to Fed predictions, and they're usually wrong in their predictions. So
Yeah, like
maybe the short end
like
of the curve goes
24 was
even,
totally wrong.
yeah, maybe the short end of the curve goes even
Yeah.
lower than that. I don't think long-term rates like the 10-year is going to go down much. over the next year. I think it'll stay north of 4, maybe 380 to 450 if I had to put a range on it. And the market, like anything else, is something we all have to operate in. And it really, I think there's two kinds of forecasters out there, Axel. There's forecasters that are full of shit, and then there's forecasters that don't know that they're full of shit.
Okay. Okay, cool.
So how long this buyer's market lasts is anybody's guess. And I'm just talking about multifamily real estate, not single family. Some markets are hot, some markets are, I think, but there's just a lot more liquidity and a lot more buyers for multifamily out there at an institutional level. I think there's always opportunities to buy. We're selling our first asset in 2 years, so I think there is some opportunities to sell assets again coming into play in certain markets. But to call like what it's going to be at the end of 2005, I try not to spend too much time on that and on looking for opportunities that I know today are going to be a great opportunity to acquire.
Yeah, absolutely. I agree with pretty much everything. What I'm kind of curious about, and I agree, I wouldn't venture to say with any level of assurance, but there are some potential bigger economic movements that on your scale, which is probably kind of like a little bit protected in your particular industry, and on our smaller scale, can make more or less of an impact. And I'm not even looking so much at the interest rate. I agree with you with the treasuries. Just as long as we have 63 trillion in debt, the treasury is much more impacted by that, in my opinion, than what the Fed does or something like that. But what I'm actually looking at is, will some of the economic promises become reality in the next few years? If that is true, then, as you said yourself, more equity will be available to do all kinds of things on all scales. If not, if those promises don't get realized, then I think it's going to remain to be a buyer's market.
We'll just have to see.
Yeah, well, we do it again in 3 years, and then we know how right or wrong we were. Cool. Now, if somebody wanted to say, okay, so I fall into this category, I have the criteria, I'm maybe in the six figures, anywhere between 6 and low 7 or so. How would they go about it? How do they get in touch?
bamcapital.com.
bamcapital.com. Cool. So last question, and independent of real estate, I wanted to ask you is, if you could meet anybody, who would it be and why?
Oh, if I could meet anyone, oh gosh, I think I would love to sit down with Sam Zell.
And tell the audience, who is Sam Zell?
Sam Zell is one of the all-star Hall of Famers in real estate. Basically, the godfather of the modern day REIT. Some people called him the grave dancer because he was able to buy lots of assets when no one else could, when there was very little equity and there was lots of deals. And he also became very successful in private equity. Real estate was only one of the things he did really well. And I've read his book, watched his interviews, and really admire his accomplishments and how he did it as well, and the person he was off the playing field.
So would it be fair to say you think there are some secrets that you only get when you talk to him directly?
The older I get, the more I try to read autobiographies, and the more I seek out CEOs that are farther up the mountain than I, who might share a little wisdom with me on how they got so high up the mountain.
Yeah, exactly. I mean, it's, the people that you surround yourself, there's some truth to that. And, as you grow and as you get better and bigger, the same 5 people from 10 years ago, be inspired by or aspire towards, right?
Usually I'm just hoping to get 30 minutes, but if they're willing to hang out with me, that's fine too. That's great.
Okay, cool. Well, thank you so much, Ivan, for coming on the show. It's really been an honor. I really feel it's great that we could do this again for a second time.
Absolutely, Axel. It's a pleasure to be here.